The Expanded Ledger Grade 11 Accounting. In this section we introduce several new types of accounts called revenues, expenses and drawings. We introduce a new financial statement called the income statement and expand on how the owner's equity is shown. In the prior lessons, when we had business transactions that increased or decreased the capital of the business, these were shown as debits or credits to the capital account as shown in the EVBO example here. The owner of the business could see on his balance sheet a single capital amount that represents her stake in the business, but had no idea why this account increased or decreased between fiscal periods. The typical owner of a business would want to know how her business is progressing, what efforts she is making money from, called revenue, and how much money is spent is get that revenue, called expenses. She may also likely want to know how much money she withdrew from the company for her own use. In order to show this information, we expand our ledger of accounts to create revenue, expense and drawings accounts. These accounts are combined together to create a new financial statement called the income statement. This statement shows the revenues earned during a period of time, the expenses incurred to earn that revenue over the same period of time, and how much money was left over, known as net income or profit. Here is an example of the new expanded ledger. In this example, previously we had credited the capital account when we provided a service, such as a haircut, and debited the capital account when we incurred a cost such as a repair or paid rent for the building. In the expanded ledger, these transactions are posted to a new set of accounts. A capital account, that does not change unless the owner invests more money into the business. A drawings account, which tracks the amounts of money the owner has taken out for his own use. A fees earned account, where all money earned for services performed are gathered. And various detailed expenses accounts such as advertising expense and wages expenses, which gathers transactions and places them in individual accounts so the owner can see where money is being spent. These accounts combine to give a much more detailed look at the progress a business is making over a period of time. The income statement. The new trial balance with drawings, fees earned and expense accounts gives far more information to the owner. Accountants show this increased amount of detail with a new financial statement called the income statement. The income statement is a formal report that shows what period of time is covered, a month, quarter or year. The amount of revenue, shown as fee earned, over this period. And the expenses incurred over the same amount of time. The amount of revenue minus all of the expenses for the period show the amount of net income. This is basically the amount of money the owner has available to take home. Net income is also known as profit or the bottom line. The use of the phrase bottom line is common because the net income or profit of the business is of major importance to the business owner. Net income versus net loss concept. If revenues in the form of fees earned exceed the total of all expenses during the period, the company will have net income or profit. Businesses are run in order to generate a profit, so net income is a good thing. However, if revenues earned are less than the total expenses incurred, the business has a net loss during the period. This is known as losing money. To business owners, this is not a good thing. Who uses the income statement? Several groups of people find the income statement contains important information. The owners, to see how much profit is being made and make appropriate business decisions. The bankers, if the business has bank loans, the banker will want to see that the business has net income in order to assess whether the owner can make interest payments and eventually repay their loan. New investors in the business would like to see the profitability or net income of a business to see if they should give the business more investment funds to help the business grow. To summarize, the expanded ledger of accounts now includes revenue and expense accounts to show the owner how much was earned during the period. This is the end of the revenue and expense section. This is an epic fail because the sign shows strawberries but says cherries.